The purpose of the Global CFO Council is to provide an educational and networking forum for senior financial executives in order to share best practices, discuss current financial issues, and to learn about current topics related to the performance of their jobs. Membership is open to senior financial executives including CFOs, financial VPs, and treasurers. We hope that you'll become a member of the Global CFO Council today. To join, please visit the membership tab at globalcfocouncil.com.
Gib, I'm going to introduce you here. Some of this may or may not be true. Tell me if I'm lying here, but Gibbon Sloan, senior partner over at VAM Virginia Asset Management, 20 plus years in the game, NC State grad, proud Wolfpack member. We were talking about how my boss, CEO, and my day job of the engineering firm, he is a proud Wolfpack graduate and cries every Monday because their football team is apparently not awesome this year. So God bless you for putting some cheer on your face for a moment and presenting with us. Also, I like to add one extra little fact. I know you're a super volunteer in the community, tons of volunteer activity, a public servant. I think you serve on a couple of things and some committees and some planning boards, and married with 2 kids. So you got a lot going on, and really excited to have you here. I'm going to mute myself, hit you with some questions at halftime and at the end. Gib, thank you very much.
Thank you, Robert. And the fact that your boss can wait till Monday to cry, then he's a much more experienced alumni of our fine university. I usually don't make it past midnight on Saturday before I've lost it. So as always, we're the team here is always very happy to and very, very humbled to to work with such a fine group here, and give us a few minutes of your time just to talk about a topic that we have found as we near the end of the year. We get a lot of questions around. So what we're going to do today is we're going to kind of focus in on some kind of key aspects of the One Big Beautiful Bill Act. I do not get any credit whatsoever for the naming of this particular piece of legislation, but obviously the creativity folks were in full drive on this one. Although I must give credit to prior tax legislation, because they, I think they're all designed to make us feel good and optimistic when they come out. What we're going to do is we're going to focus in on about 10 different aspects of the One Big Beautiful Bill Act. And the reason that we've kind of identified these, right, is as we have gone through and worked with a lot of our business owner clients subsequent to the passage of this legislation back in July, we have found that from a planning standpoint. So I always want to make sure that I'm real clear on this. We are not accountants. Right. So when it gets into a lot of the really in-depth nuances about a lot of this legislation, where it goes on the tax forms, behind the scenes calculations and stuff like that, we are informed, but we're not experts. However, where we do play a much more active role is in working with organizations and helping to make sure that they understand that certain aspects of the tax code create some planning opportunities. And so what we tried to do is put together a handful of topics that we could spend a little bit of time on this afternoon, where we think there's kind of a practical application, perhaps in the role of being a CFO, a leader in an organization, but from a business plan standpoint as well. So we're going to touch on some aspects of the increases in the standard deductions and individual brackets under the new tax legislation. We're going to talk about how the changes in the child tax credit are things to be considered. Senior bonus deductions, that is new this year, retroactive for 2025. Kind of the impacts that we're seeing from a planning standpoint on the increase in the SALT deduction, how companies are starting to deal with the no tax on tips, no tax on overtime issues, kind of some of where there's a nexus between individuals and businesses on the car loan interest deduction, state gift tax exclusion increase. Just a few thoughts on some of the 179 business expensing things that we're starting to see, and how some of the benefits that have been extended and improved around employer child care and development. We're going to touch on those as well. Okay, so let's go on and roll our sleeves up and dive into this. Okay, so if we go back in 2024, the standard deduction amounts, and I'm going to kind of focus in on probably just the married filing jointly, so it doesn't sound like I'm just rattling through a bunch of numbers. We're right around $29,200, and that's where things were prior to the One Big Beautiful Bill Act, and it did allow for some fundamental adjustments, based on cost of living and inflation adjustments that was built into that original legislation. What we see with the new legislation is that we see some rather substantial increases in the base standard deduction schedule. So we know that for 2025, that number goes up to $31,500 for individuals that are married filing a joint return, and in 26 we see another increase up to $32,200. From an obvious standpoint, one of our key kind of takeaways here is that more income each and every year with this legislation is shielded from tax, which really does kind of amplify for a lot of individuals. And thinking through some things from the business standpoint, it amplifies some of the benefits, whether it is tax-free or non-cash benefits. And we tend to see that there's more sheltering of income for low and moderate income households. I would say for the folks on the call today, that this particular piece of the legislation really does help to reduce the marginal value of some pre-tax salary reduction strategies, especially kind of at the lower end. But it really does help to kind of amplify and makes deductions and credits, relatively more valuable to folks kind of at the mid to high, the higher, in the mid to higher brackets. If we take a look at this kind of from a graphic, look at this graphically, we can see, right, there is and of course, everything's just scaling when we show bar charts and everything. I always love when I watch CNBC and it looks like this bar chart's just gone off the roof, and it's, they're measuring in decimals, so it's very little difference. But regardless, we do see some notable increases in this, and it's definitely playing a role in individuals as they're filing their taxes, and it does help with some planning around some benefits and compensation structures as well. Okay, if we take a closer look also at where we are from a tax bracket standpoint. A lot of times where we're working with our clients is really trying to find the nexus between short-term capital gains, ordinary income taxes, and long-term capital gains. And what I would say is, even though we've seen continued increase on the expansion of ordinary income brackets, and we're seeing more money flowing through in the lower brackets than we have in previous years, it's still, from an investment standpoint and a kind of larger strategy standpoint, helps us to have conversations around income that comes in, tax at ordinary income or short-term capital gains rates versus what we can run through the long-term capital gains rate. You can see. So we basically we put on this screen kind of the individual, filing a single return or an individual return, what those brackets look like. What I would tell you is that there's two particular areas of this tax of the current tax code that really do kind of that really do kind of stand out. And from a planning standpoint, I think it's really worth noting. And one of those is where we're looking at income levels up to and including the 12% bracket. I know we don't have it on this screen, but if we were looking at a married filing joint return, you can run up to about $96,950 and kind of fill up that 12% bracket. Once you do, right, so there's two brackets that were intentionally carved out in the new tax legislation as a carryover from the Tax Cut and Jobs Act. So one of them is income thresholds over the 12% bracket. You get the single largest percentage jump in income tax rate in the tax code. It's a 10% increase. You go from a 12% to where the next dollar is going to be taxed at a 22% rate. The other area that we pay particular attention to are those incomes that where we get into where the next dollar is taxed above the 24% rate, because then we get an 8% rate. The reason I bring these two up, and if we go back to the Secure Act that was passed several years ago, kind of right there in the throes of COVID, we saw that required minimum distributions for folks were extended out to age 73 and 75. This was not a generosity. Well, it was sold as the government being very generous. Look, we're not going to tax you to a later date. But if we look at calculations done by the Congressional Budget Office, those individuals that have had meaningful occupation, saved meaningful amounts in the pre-tax side of the 401k accounts, the shift of allowing required minimum distributions to now wait for a lot of us at 73, next kind of group down the road is going to be 75. That continued deferred tax growth of those accounts throws a much larger percentage of the population to where when they do take required minimum distributions, they're going to be taxed at higher rates. So that works out. The other thing I'm going to point out here from a planning standpoint is that, and again, apologize, we don't have it on this particular slide, but the 0% long-term capital gains rate runs up to right at that 96, kind of that 96.6 number as well. So if we've got folks that are trying to combine income streams and maybe if taxable earnings are kind of below that $96,000 limit, and we can figure out the way to bring in other streams of income to those folks using assets that are taxed at a long-term capital gains rate. Those assets come in at a 0%, can be taxed at a 0% rate. So there's a lot of kind of key planning issues around income ranges right there just below the $100,000 limit. So I think that's something very important for us to kind of pay attention to. As we go into 2026, we're going to see these income limits be at these rates, and then at 2027, they should increase by about another 4.5%, allowing more income to go through at the lower brackets. Okay. Obviously, for higher income earners, we remain to have codified at the high end 37% limit. So again, it's so when we're looking at creating deferral strategies and when we start thinking about things like executives that have the ability to exercise stock options, we're playing around with bonus schedules for folks that are entitled to bonuses, restricted stock investing. A lot of that modeling stuff, we really need to make sure we're using some of the more accurate long-range models based on where we see the future tax brackets occurring. Okay. And again, just kind of highlighting where we see that that 37% top end tax bracket for single filers. All right. When we look at the third item, the child tax credit. When we look at this kind of new structure that is rolling out with the One Big Beautiful Bill, what's kind of important here to understand is a portion of when we're looking at this, the child tax credit does give us a modest increase, right? It's increased by about $200 from $2,000 to $2,200 per qualifying child. Again, beginning this year, there is a fairly robust indexing feature to this as we move into outlying years. When we're looking at some of the mechanics of this, the credit is still partially refundable. Up to about $1,700, depending upon income and some of the phasing rules that are in effect, which means some families can receive the check even if their tax liability is relatively low. So it does kind of help at that range of the income brackets. Phase out, we still have a phase out that comes into play with this. If we're looking at single filers, the phase out starts around $200,000. For joint filers, starts right there around the $400,000. So when we look at higher income folks in the workforce, even though the limits are higher, we still may not be able to receive all of the benefit, but we still can be exposed to the partial benefit. What I would say from thinking about a kind of a planning aspect to I think it's important that how we really want to kind of focus on how this interacts with certain equity compensation packages and K1s. When we see certain spikes in AGI from bonuses, stock option vesting, and certain liquidity events that could occur, it can wipe out those credits unexpectedly. So when we're thinking about allowing certain income components, from an equity standpoint, or if there's ways to kind of shift income strategies across multiple years, it does open the door in certain situations to think about certain deferred compensation strategies, which allow the certain spikes in income to be paid out a bit more methodically to protect some of these benefits. It can be a real advantage to certain key employees, especially if those employees have larger families, and this credit's worth a whole lot more. Okay. So again, we kind of take a look at that, just a graphic standpoint. This one's new for us, and it does give us some really kind of unique planning opportunities for us to kind of think about. So the new tax legislation adds a second above the line deduction for calendar years 25 through 28. So this isn't permanent, right? I'm sure a lot of you already have done this. But one of the things that is really very important to note about the tax legislation as a whole, as my grandfather would say, there's a lot of comings and goings with this one. There are a lot of systematic phase-ins of different aspects of the law. When we look at things like some of the energy credits, we're not going to cover that today, but not everything that is highlighted in the One Big Beautiful Bill goes live this year. It's phased in over years, and we see aspects of this tax legislation phase out. And this is one of those, right? So this $6,000 per person bonus for those individuals that are over the age of 65, this is in addition to the standard deduction. But again, it's retroactive for this year. So, we're working with folks, in our planning aspects to make sure that it's included, right, in tax calculations. And when we're looking at withholdings and things like that for next year, right, we want to make sure that this is included as well. But if we've got a married couple filing a married joint return and they're both over age 65, it's another $12,000 in deductions on top of the standard deduction that's currently in place. The bonus is targeted, right? So like a whole lot of different aspects of the legislation. Again, I'm going to pick on married filing a joint return. The sweet spot is for those individuals that have modified adjusted gross incomes around $150,000. Now it does it is a bit unique because it does start to phase out, but it never completely fully disappears. So even at much higher income levels, you still get a little bit of a taste of this one. So it's there, it's there, and it's intended to benefit those individuals. Where we're seeing this, right? So this is playing a fairly dramatic role in a lot of planning aspects because it materially lowers the effective marginal rates for many folks over the age of 65. And this can come into play for retired executives, business owners, especially in that kind of age 65 to age 75 window. It can play a dramatic impact on things like Roth conversions. It can enhance the conversation, right? Because if it opens up the door where, because of the standard deduction, I'm in a prematurely, premature is the wrong word, but I'm being forced into a lower tax bracket. It could open the window for Roth conversions and make those much more attractive. On the flip side, right, if doing a Roth conversion gets you above, takes you into a bracket that starts to get you in the phase out, it may put a little bit of a damper on kind of thinking through Roth conversions. From a company standpoint, right, where if we have in companies that have employer stock in the 401k plan, it can affect NUA strategies. When we're looking at things like installment sale structures for folks that have an ownership interest in the business, sometimes those can be a little bit more attractive because the additional income is now partially shielded by these kind of specific deductions. So this one's playing a really important role from both kind of a leadership planning standpoint, but also as we look at some of those income strategies from a business standpoint, but certainly from an individual standpoint in their planning as well. Okay. SALT deductions. This is a big one, right? Go way back to the Tax Cut and Jobs Act. There's no politics, all politics aside with this one because they're all really blatant about it. Republican legislature really thought there was a great big disadvantage that the kind of the very dominant blue states. So the traditional New York, New Jersey, Pennsylvania, Rhode Island, Connecticut, California, areas around Seattle and Washington, getting tremendous tax benefits, through the state and local tax deduction. Those got pulled way back, right? Because many folks from kind of southern red states, they didn't see those benefits. So the belief was it was kind of a giveaway in the tax code for the wealthier New England and West Coast states. A lot has changed since 2017, and we find now that kind of regardless of where we live, there are larger cities, more expensive home, higher property values, predominantly now in the South. So this got revisited hard. So the cap went from 10,000 to 40,000. So that makes a big difference when it comes to planning aspects. So as I was mentioning, the cap can rise as high as $40,000 for taxpayers below $500,000 in modified adjusted gross income. Covers a lot of folks in the workforce, right? The details are kind of complex, right? So I'm not the guru in the actual underlying calculations, but broad sword, under $500,000 in modified adjusted gross income is potentially $40,000 on the table. It does a couple things for us. So first, it allows for much higher deductibility. And if I'm in an area and because of taxes and because of the value of my home, right, if I can get up to $40,000, it can also get me above the standard deduction. which opens the door for the idea to do more itemized deductions and things like that. As we get into substantially higher income, the cap does start to scale back, but there's always at least a $10,000 amount available for everybody across all income limits. So up to $500,000 is a sweet spot for that $40,000. I would say, from a planning standpoint, things we want to look at is that if we have, on our team, individuals that are high earning employees that are in, kind of higher tax states, and depending upon the nature of your business, getting back the monies through that deduction is something important. And sometimes it can play a role if we're asking employees to relocate, and looking at the difference in property values, what that deductibility looks like, and it can play into, in certain situations, relocation decisions and compensation offers in different markets, right? We had seen prior to employees and companies not wanting to relocate employees into areas where property values and state and local taxes were higher. This perhaps changes some of those conversations for us as we look through some of these things. Okay. Again, just a little bit of a kind of side-by-side comparison here. The new tax legislation gave us some new tools to play with here. So it now literally creates a deduction that effectively removes potentially up to about $25,000 of qualifying tips from taxable income for eligible workers. Again, it's retroactive for 2025, but it also, this is something that doesn't have much of a lifespan past 2028. So there's some guardrails with this one that I think are important. So tips must be qualified, which means there's a reporting requirement. So we got to own up that we earn the tips before we can take a deduction on. So voluntary cash or charge tips, they need to be properly reported on the W-2s, or I think it's Form 4137 by the taxpayer. The deduction is capped at a $25,000 per year. And if I'm self-employed, right? If I'm self-employed, primarily in the hospitality, travel, and some professional services, the deduction cap cannot exceed my net income. So there's no scenario in here where we can show a loss or something like that, because of this. For individuals, this deduction phases out at about $150,000, and for married individuals, it's about $300,000. So really, kind of grand scheme, and by design, this was intended to help both businesses and employees, primarily in the hospitality, travel, personal, kind of the personal services business, kind of at the lower end of the wage spectrum. And it does create some unique situations, right? If we have if we're married and we have a couple of different folks that receive a significant amount of income through tips, it can make some really meaningful difference, for individuals. But again, it's also something that can, from a compensation standpoint and a compensation design standpoint from businesses, also be very attractive. And it's important though, because the provision also can create some interesting impacts and influences on wages, tips, kind of the mixed design, and the effect that it can always have on income that's reported ultimately for mortgage underwriting and certain benefit eligibility. So all these things kind of come into play from tax planning standpoint. Okay.
Yeah. Question on
absolutely.
that. I worked my way through college waiting tables, but it's been a long time ago. If it's now being reported, if I'm the employer, I'm the restaurant, Am I taking tax on this reported tips? Am I not taking out tax? What's the timing of this this tax situation? How are restaurants? How's the hospitality industry handling this?
So the ones that we're working with, so right now it's kind of a mad dash to figure out the reporting for 2025, right? Because we got the final language in August, and obviously folks were doing this. So my understanding is right. So my understanding is that there is an allowance. So this is where I got to make sure I clarify. I'm not an accountant, but my understanding of how the mechanics of this are working is that taxes are not being withheld up to that $25,000 limit. However, it is subject to what I'm being told is it is subject to FICA, FICA taxes. So that is being withheld, but because the deduction, the deduction does take us up to the $25,000 limit, and employers know where these individuals should be filing, from an income range, if they're individuals. My understanding is they're not doing the tax withholding on the first 25,000, but they are doing calculations on FICA.
And some of these maybe you know, maybe you don't, but I'll just ask them. We talked a little bit about the R&D tax credit, and I've been trying to poke my head up and catch up on all these changes. I've been really busy this year, but is my absorption, my understanding correct that for a little season R&D was capitalized instead of expense? Now it's expensed back to the way it used to be, and then there are R&D tax credits. Have we kind of reverted back to the way things were 2 or 3 years ago, or is it more complicated than that?
Well, it's a combination of the two, and actually, I am going to go through the 179, that section 179 stuff here. The I think the practical takeaway from that is, we've doubled the amount that we can run through it, and the ability to expense much faster, right? We can do 100% much faster. I think gives us that benefit there.
I'll hold the other questions to the end. We've only got about 26 minutes, so we've got a few questions, and I'll hold them for the end. Thank you.
Yep. We're kind of right. We're kind of cruising right through the middle of this, so we should be good on this. So the other thing that I think is important, from both an employer business planning standpoint, but also does play into a role with employees, is the no tax on overtime deduction. So it is important to understand that it's really only the premium portion of overtime, right? So if overtime is time and a half, it's that 0.5, it's that half, the premium component that is targeted. There's a lot of guidance on there that kind of plays forward on how to approach it. But it does pretty much allow for kind of that straightforward deduction up to certain statutory caps. 12,500 for individuals, 25,000 for individuals that are married, filing a joint return. Kind of like with tips, the deduction phases out at around 150,000. Excuse me, $150,000 for individuals, $300,000 married filing a joint return on a modified adjusted gross income basis. This one really is starting to target more mid-income workers, and it's really those kind of focused to benefit those folks that the overtime component of working adds a significant contribution to their earnings. I think from an employer standpoint, right, we probably will start to see more employees wanting to volunteer for some overtime work because of the effective after-tax pay really can be significantly higher. We've had a couple folks, that we work with that, to the extent that they do some labor cost modeling, it's important to really kind of focus in on what that modeling looks like in those environments where we've got a lot of frequent overtime and it's a consistent part of a lot of employees. We see that a lot right now in development companies. We see this impacting a lot those trades where there's certain labor shortages, HVAC, electric, plumbing. This is going to have a real meaningful impact in those industries, and it does kind of come into play about, does it make sense, from a forward-looking standpoint? Do we look to make certain adjustments, kind of with base pay versus kind of overtime and that mix when kind of structuring those compensation models, moving out a little bit forward there. Okay. When we're talking about the inclusion of the language now about car loan and interest deduction, we may be thinking, where does that have any application to the conversation today? It's important to kind of frame that this is retroactive back to December 31st of last year, but it is fairly. This one's got some pretty strong guardrails on it. It does kind of resurrect from the past, right, a form of personal interest deductibility. But it is very specific to car loans on qualified car vehicle purchases after December 31st of last year. You can claim up to $10,000. You can claim up to $10,000 worth of interest per year, and it can be deducted if the taxpayer's modified adjusted gross income for an individual is under 100K, 200K if for married filing a joint return. The vehicle must be brand new, cannot be used for used car purchases. It must have had its final assembly in the United States. Kind of interesting because there are a lot of cars that maybe don't come from brands that we think of that would be labeled as U.S. cars, but the final assembly of those vehicles does take place in the United States. A car needs to be under 14,000 pounds, and it must be used for personal use, right? If we're writing it off for business use, you're working that out. Where we've seen some kind of interesting things, or at least some conversations starting to perk up, it's having a little bit of a change in the conversation around, for certain individuals around the math between buy and lease, right? It's making the buy side of the equation a little bit more attractive, for employees and certain owners that are kind of in those middle income tax bands. What we may see, right? And I had, got, one business owner, we're starting to see some employees kind of coming forward and asking for car allowances, in exchange, and instead of using company vehicles. And it's kind of interesting. It may have an impact on how we approach traditional fleet programs, from an employer standpoint. Especially if employees start to kind of figure out the tax leverage there. So it can be kind of interesting, right? If I'm an employee and maybe I'm getting paid some mileage to use my own car, and now all of a sudden I can deduct some interest on it. It makes the math kind of interesting there. And we may see, as this thing continues to kind of work its way through, some interesting conversations between employees and employers. And it could maybe change the role of the employer being a little bit more top heavy responsible on having perhaps a small auto fleet or cars that they allow certain personnel to utilize. We'll see. See how that kind of plays out. But there is an application here that we're seeing between, where there's a crossover between employees and employers in certain space, especially around those folks that are kind of in a sales role for a company. So something to think about there. Okay. Estate tax, the estate and gift tax exclusion. Good and bad here. We very careful to make sure we remind even business owners. This has a real bearing on folks that have equity and ownership positions in companies. Okay, we're very careful because this is advertised as making the estate and gift tax exclusion permanent. I'm sure I don't need to mention to anyone that's on this call, permanent means it's permanent until it changes. There is no such thing as a permanent change to the tax code. However, there are a lot of folks out there that do think it's been made permanent, that it's been codified, that it can't change. So we want to make sure that we have those good conversations. Bottom line on this one is starting in 2026 and beyond, the estate and gift tax exclusion is going to be $15 million per individual. It is portable to a spouse, so $30 million, for a couple, and that number, that 15 million, should stay 15 million. I have not seen any language where the 15 million will have a cost of living adjustment on it, unless it's changed by future law. Okay, the portability is also an important component here. I'll tell you where this really has the biggest impact, right? It's getting a lot of people, so business owners, folks that have large equity positions, right, in their own business or in leadership in certain companies. This has a real important component to it. Is up until July, this all sunsetted in December of this year under the Tax Cuts and Job Act. So it could have gone back as low as $1 million. I think all practicality would drop back to about 5 million. So knowing that at least for the next probably through 2028, it's not going to change, is really helpful from an estate planning standpoint. But when we look at the owners of closely held businesses, executives that have concentrated equity positions, it extends that runway, right? But when we look at certain strategies, right, certain grantor trusts and things like that, and working through some of the recapitalizations from an estate planning standpoint, it's giving us more time to work through these things without this cliff hanging at the end of the year. It's still, in certain situations, we live in a time where, depending upon the industry, underlying values of businesses and assets can really grow over time. So we see a lot of business owners, especially maybe in the development space, where part of the business model is creating business entities that they want to exist in separate LLCs. We still are very focused on utilization of trust strategies so that any assets that have the potential to grow rather rapidly, we want those assets to grow outside of, outside of the individual estate, right? We see a lot of family trusts now owning LLCs, different business entities. I don't think the fundamental planning for folks that are in this space has changed much. We just have a little bit more time to do it, and we're not as pressed to get as much into the trust as maybe we were the year before. But it really does, and for those of you that work with closely held businesses and things like that, this is the stability that we've got over the next couple of years is very helpful. It does not eliminate the need for the planning, though, in a lot of situations. Okay. All right. Robert was mentioning the business expense. So, um, essentially what we're talking about here is that, um, for a lot of closely held businesses, this really is one of the most impactful of the corporate provisions under the prior law, right? Prior to this change, and this all kind of falls under Section 179. The limit was was about $1 million, and it began to phase out beginning around about $2.5 million on qualifying property that we placed into service, right? And we'll talk about what property is on the next slide. The one big beautiful bill, the new tax legislation does a couple things. One, it grows the maximum deduction significantly. The maximum deduction now goes to 2.5 million, and then the phase out threshold up to 4 million. And it makes the ability to do 100% expensing a bit more permanent as tax legislation can be, of course. The other thing that we're hearing from a lot of folks that's really very attractive to this is it also allows for a much faster accelerated depreciation regime for qualifying non-residential real estate as an essential part in any kind of manufacturing or production operations. We're seeing that, that accelerated depreciation being something that's really very helpful. So from a planning aspect, right, if we kind of narrow in on this, capital intensive businesses can really benefit from this by front loading more deductions into the year of acquisition. I think it's going to give us the ability to be able to smooth out a lot of cash flow and kind of reducing taxable income, especially in those primarily growth focused years. I think it gives us an opportunity, right? If we're in a business where CapEx is something that we're always dealing with, looking at that, revisiting those plans under the scope of the new legislation, which I'm sure probably almost everybody has. I do think it kind of brings back to the table some fundamental discussions around lease versus buy decisions, and those kind of bonus depreciation assumptions in light of a lot of these new 179 limits. And just as kind of a quick refresher, and Robert, I probably owe you this slide. I kind of added it at the last minute, but I'll make sure I get it over to you. So when we're talking about, right, what those 179 expenses, those qualifying properties are, we're talking about machinery, equipment, computers, printers, off-the-shelf software. We're living in a world now where we see a lot of our customers having to upgrade servers, right? Bring on the ability to process more data, interconnectivity with AWS and the different, this whole artificial intelligence thing is a CapEx intensive process. So whether you're in that business, right, or you're the beneficiary of that business, these things make, important. Office furniture and equipment, certain vehicles, they got to be the appropriate kind of vehicles. Qualified real property improvements, improving roofs, HVACs, all that kind of good stuff, and buildings that need to be acquired from a non-residential standpoint, all really, play an important role here. Some of the stuff that generally doesn't qualify, includes land, permanent structures, kind of the building itself, intangible assets, patents, copyrights, that kind of stuff doesn't qualify for it. But it really, this is one of those things where we've really upped the game. We increased that, deduction by about 150%. So it's kind of a whopper there. Okay. A couple more slides and we're gonna line things up. So basically what we're looking at here is really just kind of a summary of kind of family workforce provisions. that individually used to be smaller, and still are kind of small, but collectively it can particularly play a role in a talent attraction strategy. We think the employer child care credit rises to 40%. For certain small companies, smaller companies, it's 50%. It's got some annual caps jumping, 150,000 to 500,000. Again, certain smaller businesses, the number is as high as 600,000, which can make on-site or contracted childcare arrangements for employees significantly more attractive than they were in prior years. When we kind of couple that with the benefits that are available for individuals, they've increased to 7,500 for families to give a little bit more room to shelter certain childcare expenses on a pre-tax basis. Still talk around kind of the new Trump accounts, tax advantage savings vehicles, funded up to about $5,000 per child per year. Those children need to be born in 25 through 28. And they're still talking how those things are going to be managed. 529s also were really expanded. They've really become the Swiss Army knife of anything that we call education now, K through 12. Also, workforce training costs can be recovered, can be covered in those types of things. So, if there are some strategies here, right? So if we, for a lot of those things, if you're an individual, even if you don't use it as a savings vehicle, if you're paying for any kind of job training, community college, any 4-year college, even if you just run the tuition payments through a 529 account or housing expenses, whatever those things are, you can get a tax deduction on it. I think from a practical planning standpoint, this kind of set of tools really opens the door, I think, a little bit more of a robust kind of family-oriented benefit designs, if that's something that's important to the culture of your company. And you can kind of get to a place now between employer and employees. You can really get this thing. There's a lot more tools now to get kind of an effective lower after-tax cost on that. Okay. So I'm kind of wrapping up here. So I think last couple slides. I'm not going to read through
Gib,
all of this. Yes, sir.
Let me pause. We're going to run out of time, and I have questions. I'm going to hit you rapid fire, and I'll send out the rest of the slides, the final slides. And these are pretty specific questions. If you don't know, say pass, but I'll just hit you up. One is and this came up during the overtime and the tips part of your presentation. I got a question around W-2s and what are the requirements of W-2s that need to go out here in just a couple of months out to employees to show what the employees need to see so they can do their tax returns. You seen any information on that? What payroll companies are doing to be prepared?
That one I need to phone a friend. I do not know. I do know that on a lot of these things, there is a scramble on how to get a lot of this stuff incorporated for year in 25.
You were talking about cars, and you mentioned there were some cool deductions around cars and interest and lease versus buy. One of the questions was if the car was bought before 2025, but it is now 2025. Can interest for that count? You don't get so negative until I finish. No, there's nothing there. I got to buy another car.
You should get a great trade-in value, low mileage. Go see your local Ford dealer.
Oh my gosh! All right.
Has to be purchased after. Has to be purchased after December 31st, 2024.
You mentioned 529s, lots of expansion to 529. One of the things that was a maybe, I think, during discussions was being able to move unused funds from 529s into Roth accounts. Know anything about that?
Yes, you can. Cool. The caveat is that you're going to create a Roth for the beneficiary of the 529. So as a parent, I can't recapture the money and do a Roth for me. Now, couple caveats. So one of the things that changed, so we go back to when 529s, there was kind of a hard and fast rule that, by the age of 30, you needed to either undo it or do it. That the whole age 30 thing is kind of gone, right? A 529 plan in most states now can stay open indefinitely. So you can, right. So let's just say I set one up for my kids. Say one of my kids didn't need it. I can kind of hang out there, maybe use hope as a tactic that I'll have grandkids someday, and then name a grandkid as beneficiary as well. But yes, you can kind of pull the plug on it and do a conversion to the Roth, which avoids any of the penalties of undoing a 529.
You're not giving tax advice. I'm still going to ask you the following question because I read this, I feel like, and I cannot find this anywhere. And maybe I imagined
I'll give it, just don't take it.
Okay, that's a good point. Yeah, me too. I'm a CPA, but I barely passed, is what I tell people. Question is on the 529. So the kids don't use it all. There's a little bit less. I swear I read somewhere somebody had the idea of putting it back into your own name and enrolling in a wine class domestically or abroad through an accredited university that you're enrolled in, but use the funds for something that isn't towards a final degree, but is a continuing education. Any thoughts on that possibility?
Yeah. So if you don't mind, I'm kind of deep dive into this in a very quick process. So what you can use a 529 for now is incredibly broad. We've gone way away from 4-year college and cost associated with it. You can use it as long as the institution that you're utilizing is accredited and has the capacity to receive monies through any type of 529s or any type of federal grants or anything else like that, which is so wide open, you can drive a tractor trailer through it. Where things have changed, if I have a child that has disabilities and they need tutors, I can use the money for that. As the custodian of a 529, you can change the beneficiaries at any point in time. If I've got 2 kids, you can move it from one kid, flip it over to the other kid, move back to the first kid. You can pull it back to yourself, right? You can name yourself as your own beneficiary and use it just like that. I have a client, he will remain nameless, is actually getting really advanced golf lessons from a place that's accredited, and he's using his kid's 529 money for it.
Oh, I'm liking it. Gib, there was so much in your presentation, I was getting angry because you'd always meant something good, and then there'd be an income requirement or limitation. I get mad again. This is leaving me happy. There's something out there for me. And thank you. This has been awesome. What a great summary. I'm going to share your info for follow-up conversations. Thank you for bringing this great intel to us. I hope you have an awesome day, and good luck, NC State, this weekend.
We use hope as a tactic.
Bye-bye.
Take care.